Welcome to another episode of Your Money, Your Mission, the podcast where we break down complex financial situations into actionable advice, powered by Johnson Financial Group. I'm your host, Kelly Mould, and today we're going to take a deep dive into the financial landscape, looking back at what truly shaped the markets and the economy in 2025, and more importantly, taking a look at what we anticipate might be happening in the new year. Joining me is Dominic Ceci, our Chief Investment Officer here at Johnson Financial Group. Thank you so much for being here today, Dominic.
Great to be here.
So why don't we start with a recap of 2025? I know there were some significant events that maybe defined the year more than other things. So can we take a look at maybe some of those things, some of those narratives that kind of formed that landscape?
Yeah, 25 was, it was a weird year from a market perspective, right? From an investor's perspective. You had this driving narrative of AI, which has been going on for a while.
Right.
And so that's had everyone pretty excited. You know, you've had valuations kind of running up and things like that. And then there were these transitions to various other narratives. The big one at the beginning of the year was the policy stuff, right? Trade policy specifically. I'm sure everybody remembers. We had a client event the day after.
Exactly. April 3rd. Yeah. I remember it clearly.
Well, I remember it well. There were a lot of questions that day.
Right.
But, you know, those tariff policies were rolled out, and that surprised a lot of people, and markets sold off pretty hard. And it's almost, you know, it's such a different environment at that moment than how the year ended. It seems like it was another year, right?
Right.
But,
right.
You know, you think of the S&P ended up like 16% or something on the year, but at one point it was down almost 20.
Yeah.
In a couple of weeks.
Right.
I mean, it was crashing hard
right.
on that news,
right.
and people were really scared. And, you know, the market worked it out. Some of the stuff got rolled back. It wasn't what we thought, yada, yada, yada.
And
but
pretty quickly, actually.
Yeah. And that's still all kind of getting sorted out. You know, now there's some court involvement and whatever. But anyways, the market moved on from that. We recovered relatively quickly.
Mm-hmm.
And you ended up with a pretty good year. So there was that. I think the other big thing always really is interest rate policy. And
right.
so we're in a regime now where Fed policy has changed. They've been easing for, I think, 16 months or something like that. You know, they started easing over a year ago,
mm-hmm.
and it takes about a year for interest rate cuts to actually start to impact things.
Okay.
And we've now lapped the original interest rate cuts, and they've made some additional cuts, and there's potentially some more cuts in the future. And so those things all kind of helped, you know, get markets to where they were at. When I think about 25, if you zoom out a little bit and look more like 3 years,
mm-hmm.
you know, we had 2023 was a year where the S&P was up 24%, 25%, something like that. And then the following year, you had another 20+% year. And now we've got 25 on the books at about 16. And so you've got 3 consecutive double-digit years. And there's been earnings growth with that.
Right.
But the valuations have really gone up a lot over those 3 years. But they went up, the kind of biggest jump in valuations was in that first year in 23. About, 75% of the return in 2023 was just the multiple expanding on the market. And then in 24, about half of the return was multiple expansion. And this last year, it was like almost nothing, right? It was maybe like 20% of the total return was multiple expansion. I think you went from a 21.5 multiple to a 22 multiple. So it's kind of like, you know, it's really hard to make predictions about the future of the market.
Right.
But if you just look at that pattern over a longer period of time, it gives you a little bit of foreshadowing of 26. You probably are going to have a harder time just getting market returns on the back of multiple expansion. You really need the earnings growth to come through at this point.
Again, at this point, yeah.
And there's been some there for sure. And earnings growth expectations are very high for this year, but you're going to need that. Okay. You're just not going to get, you know, the easy money has been made on just the multiple expansion. I think.
That makes sense.
Yeah.
So that's a great segue into 2026. So we see that as some of the things we need to take into account. What do you think would be some of the other key drivers that we should be thinking about in 26?
Yeah, so 26 is a year, you know, I just talked about the market a little bit. Economically, it's a year where a lot of policy stuff is probably driving the economy. And so, you know, forecasts from various economics and institutions that do that kind of thing are between 2 and 3% growth. Mostly 3% is probably on the high side, but most of what people are pointing to are things that were passed in 25. A lot of it's tax bill stuff.
Right.
And so that makes sense. There were tax cuts, and tax cuts put cash back into people's pockets or companies' pockets, and then they should be able to use that money to spend. And, that's...
We were talking about that briefly just yesterday, and you had pointed out that even with the tax bill change, that a lot of people probably didn't go back and make adjustments given the impact they would face with the bill. So we anticipate probably some higher returns for a lot of folks.
Yeah, like actual
tax
returns on their tax.
Yeah.
Yes, because the tax bill, I forget exactly when it passed. It was maybe July of 25, whenever it was in the summer. And it was retroactive to the beginning of 25. So as you go now, we're like about to hit that season
right.
where people go and file their taxes. That bill already is going to impact your 25 taxes that you're filing now in early 26. But most people don't go back. They don't go, oh, like they passed the tax bill. I'm going to go change my withholding at work and I'm going to do all these different things. Most people don't do that.
Right.
And so you would expect that the average refund is higher than people are used to.
And that's going to drive some economic activity.
Yeah, because it's cash back in your pocket.
Right.
And hey, we live in America. People like to spend money. So, they'll take it out. They'll go do some of the interesting things that are going on this year. I mean, there's Winter Olympics. They're not in the U.S., but it's going on.
Right.
There's a World Cup being hosted here. There's the 250th anniversary of the country. I don't know, there's probably celebrations around that. Like there's stuff to do, and people are more kind of experience oriented these days. So they'll get a quick infusion of cash, and you would expect that to start happening in February already, because if you look just over the last maybe 3 years, almost 30% of the tax refunds are paid out in February. It's like February, March, April is when.
So we should see that impact relatively soon in the year, early in the year.
Oh yeah. Yep.
And then we also talked a little bit about Main Street and businesses. So certainly there's some tax bill implications for business, but there's also some potential interest rate. As you said, it takes a year for it to start to impact, but we think maybe there's going to be some benefit over.
Yeah, so in the tax bill, there's the CapEx thing, which is a big deal, and then just the ability to expense R&D and some other stuff. The capital expenditures is probably more beneficial to larger companies, but really, I think it's 84%. I don't know the exact number, but something like 80% of jobs in the United States come from small companies, maybe 500 or less employees, small, mid-sized companies. And so those companies are the ones that are really going to benefit a lot from lower interest rates. And, they can't borrow on the same terms that the huge giant companies can.
Right.
And, or the government or, an entity like that. And a lot of times the debt is floating rate, or whatever. And so as the interest rates come down, their cost of capital goes down, and then they can use that money, the savings that they'd be paying on interest, to do other things. Or maybe they can take out loans that they wouldn't have otherwise taken out, because now they go, oh, you know what? This rate's not that bad. Now we're going to go do this project that before, when we did the math, didn't make sense at the higher rate, but now it does. So, you would hope some of that stuff comes through. Additionally, and this is really harder to quantify, the whole deregulation story really factors in, and you would expect that to benefit kind of mid-sized businesses the most, but small companies as well. Because again, when you are humongous, right?
It's a different
You got tons of resources to throw at the whole regulatory thing. And there's been research on this. The kind of cost of regulation hits the hardest at around 500 employees, I think is the number. It's something like that. So these kind of mid to smaller size companies really bear the burden the most from an actual cost standpoint. So as deregulation continues to go on, you would expect that to
have
impact.
A positive impact. Yeah.
Yep.
And it's interesting because I know you and I talk about this a lot. I look at various economic factors, news stories, some of the noise that's coming in, and I will call you and say, okay, what is this going to do now to investments, to the economy, to stock market? And you constantly have to have this discussion with me about how much more factors in as we see what impacts our investments. And you had a really interesting example from 2018. I wondered if you could share that with the listeners.
Yeah. So the the example I think I made to you the other day was if I said, okay, here's what's going to happen. You're going to have real GDP of, let's say, about 3%. You're going to have inflation, low 2%, so good enough. Unemployment's 4-ish, maybe below 4. What do you think the return on the S&P? Oh, and let's throw in double-digit earnings per share growth on there.
Yeah.
Right? 18%, 16%, 18% earnings growth. What do you think the S&P return would be for the year?
Incredibly positive. I would say it's going to be a really good year because all those key indicators are great.
So what I just told you was, an approximation of 2018. That's essentially what happened in 2018. You had 18% plus earnings growth. You had 3% real GDP, low inflation, record low unemployment. S&P was down over 6% on the year, right? You had a big sell-off in December. And that's my point is you can't take the economic inputs and just go, well, that's the market. They're not the same thing. They're not. Yes, they're related. They impact each other. But like in 2018, you had other factors. Like in that instance, the Fed was doing the opposite of what it's doing today. It was raising interest rates.
Right.
And that's a huge input. Anyone that's ever gone the nerd route like I have and studied this is how you value a company and you got to take this math here and do this, right? Like one of the biggest inputs is just the discount rate, and you use current interest rates to do that. And so if interest rates go down, then things are worth more. And if they go up, then they're worth less. And so when rates are going up, all of a sudden, as an investor, you have choices to make. All of a sudden you go, well, this thing over here might pay me 6%, but now I can get this 6% interest, and that's a lot lower risk. It doesn't move around as much as this other thing over here that's kind of risky. I'm going to take the interest, right? Like you have to make those trade-off decisions because you only have so much capital to allocate. And the higher the interest rate is, the more you're going to choose, in that direction.
Right.
So interest rates are going up at that time, and that was one of the things that drove the market. And there were others. That was a year where you had trade uncertainty,
right?
Because I think we were implementing tariffs on China at the time. They weren't as broad as what happened last year, but there was other just weird stuff going on.
Right.
And I would add on to that, if you just think, and this is a simplification, but a lot of times, and this happens all the time if you watch, the financial news media, they spend a lot of time talking about the economy. And we all live in the United States. And so it's easy to think about, this is where we're at. The U.S. economy is what it is. Yes, again, related to what these companies do that you invest in. But if you just at a broad, big picture level, revenue for the S&P 500, over 40% of it comes from somewhere other than the United States.
So a global impact is much probably greater than what we have been accustomed to in years past.
Yeah.
So one of the things, I know our clients get very nervous, especially, interestingly enough, if you have good year after good year after year, everybody is waiting for the next thing, the next, like, what is going to be a problem? What should they be worried about? What should they be asking their advisors? And you pointed out that the noise we get from the financial media can be very distracting and can lead us to believe certain things have more powerful impact than they do. So there were a couple things I wanted to ask you. One, I wanted to know, AI is something we hear about all the time from our clients questioning what the impact is going to be. And I know you watch it like a hawk, kind of how this is all transitioning. So I'd be interested to know what you think in terms of AI and 2026. And then my second part of the question is, what should investors like myself be asking their advisors to make sure that we are watching the right things as we move through 2026?
So AI in 2026, it seems like we're still in the relatively early stages of this whole thing. We're still in the kind of infrastructure build out stage. And so there's a lot of money being spent, CapEx. They're building factories, essentially, these data centers that have all the chips. And so that creates jobs, and it just the building of it itself, right? That's kind of stimulating the economy, this whole thing. And you have some interesting participants that you wouldn't expect, right? I mean, they need power for these things. They need water to cool them, all this kind of stuff. Lots of construction. So that continues, but I think it's maybe slowing down a little bit. I don't know. It would be good to see some transition there because they keep building, but no one's quite sure towards what, I guess.
Mm-hmm.
And you did see in the last round of earnings for markets, I feel like investors were maybe scrutinizing earnings a little bit more. They weren't as impressed with earnings beats and were maybe a little harsher with earnings misses.
Maybe at a stage where they want to know, what is this really doing?
Yeah.
What will this really do for
Yeah,
us?
because there's this story, right? It's a narrative. AI is going to change the world. AI is going to increase productivity, so on and so forth. All these companies are going to make, jillions of dollars because now they can just use AI to do everything. No one's going to have jobs, and,
Yeah.
I don't know what we're all going to do all day.
It's interesting because this morning there was a news story on where they showed one of the conferences where they introduced the tech robots.
Yeah.
And one is a dog that moves around, and the other one was doing laundry. And I'm like, wow, that's a really expensive robot for. I have a dog, and
I know.
So I do think I can sense that people go, okay, this has been fun and interesting, but what does it really do?
Yeah. And you're starting to see that come through now, like towards the end of last year. And I think that's some of what hopefully gets sorted out in 26 is, what is the point of this? How is it really going to benefit society? How is it going to benefit investors, so on and so forth? And you've seen some of the companies, everyone was fine with all the capital expenditures on AI when it was coming from cash flows and things like that. As companies have started to go to the debt markets, they've really, people are buying the debt, it's fine. But the companies that are doing that have started to really kind of suffer. And investors are kind of going, nah.
What's going on?
Not impressed, right?
Okay.
And hopefully that's good. I think it's good. It's healthy. But that should get sorted out in 26. So at some point, somebody's got to go like, hey, here's some real data that shows that this meaningfully changed, this business,
right,
whatever. And then it needs to compound and whatever. I think that's part of why, when I go back to where I started talking about the multiple expansion thing, all the excitement's kind of baked in at this point.
Okay.
I would hope.
Right.
And so now you're really going to need the earnings to come through, and those earnings would come through on the back of some of this. Like, yeah, we used AI to help us make whatever process more efficient. Therefore, our earnings are higher.
Here's the consequence of that effort.
So that's where it should go. I think it's kind of a case by case, scenario. I've used it a ton. I know you've messed with it.
Yeah.
It's maybe some of the stories get oversold on the news.
Yeah.
Right. Like if you actually use it, you go, this is cool,
but it's not perfect.
And
right.
It sure is
Isn't
not
replacing
a whole bunch of people at this point.
Right.
It's pretty dumb actually for a lot of things. You got to correct it. And actually maybe the worst part about it is that it's not doing this on purpose. It's just, it's a machine. It's like, it doesn't know. But it tells you kind of bold-faced lies sometimes. You'll go, hey, this thing that you did is wrong. Fix it. And it goes, oh, yeah, you're totally right. I fixed it. Thanks for letting me know. It didn't fix it. It didn't change anything. Like, what? And there's been no real major regulation around the AI stuff, but you're already seeing these kind of anecdotal cases of this accounting firm used AI and AI made a mistake and now they had to pay hundreds of $1,000s to fix it. Or this law firm or these lawyers used AI to help solve cases or whatever. And now, the judge said, hey, these things that you cited didn't actually happen. They're not real cases. And it's like, oh, sorry, the AI made it up.
Yeah,
right.
That's a problem.
Yeah, that's a big deal.
Problem.
You're right. Like,
yes, I do. I would not. Yeah.
So at some point that all has to get reeled in.
Yeah. Interesting.
Yeah.
Very interesting.
There's so much to sort out there.
So things that an investor should definitely ask their advisor in 2026.
So there's the basic question: Does my plan work? Right.
It's always how we start. And now I want to do this. So does my plan still work?
Yeah. Am I taking an appropriate amount of risk for what I'm trying to do?
That's an important question because I don't know that people often look at that and really analyze. Here's how much risk I'm taking, at what cost, and here's what I should be getting.
I think that's really a big question that you should be asking all the time because things change.
Right.
And with each passing year, as you're invested and you make more money, if your goals aren't changing and they're better funded, you might not need to take as much risk. And so you could back it off. So if you're really nervous about stuff all the time, maybe you have $2 million worth of goals and you've got $10 million in the bank.
Yeah.
You got to know yourself to some extent.
Right.
I mean, at some point maybe you're planning for other people, legacy, whatever, but
Right. But know what your goals are and
know what your goals are and take the right amount of risk for that.
That's great. That's good advice, and really thinking about that risk. I really appreciate you sharing your insights today with everybody. Is there any final thought that you have for 2026?
I mean, look, it's like any other year. There's going to be a lot of noise, and there's going to be stuff that's distracts from the goals, from the targets. If you get too distracted by those things and make kind of impulsive decisions as it pertains to your investments and things like that, it's almost always bad, right? Usually those outcomes are not good. So that's why you want to proactively ask the questions that we just talked about. Like, am I taking the right amount of risk for what I'm trying to accomplish? Does my plan work? What do I need to do to change that if it doesn't? So on and so forth. Like, be proactive about asking those questions. Make sure that you know where you're trying to go, what the path is to get there. There's going to be some turbulence on the way. Do you have the stomach to navigate it or not? Right? Like, talk about all those things. And then when the noise happens, I mean, look, it's the beginning of the year. There's already weird stuff happening.
There's already noise, right? There's
and
already things.
People are already concerned.
Right.
And that's every year, right? It's always, the path is not a straight line. It's never easy. You've got to be able to hang on for the ride. And if you can't, then you need to change your strategy.
Yeah. That's great advice. Thank you so much, Dominic, for spending time with us today. And thanks so much for tuning in. If you have questions, make sure you go to the show notes, type your question, and hit submit, and we'll be happy to try to tackle that. Also, make sure you subscribe so you don't miss out on any future episodes of Your Money, Your Mission, the podcast designed to turn complex financial situations into actionable advice, powered by Johnson Financial Group.
This podcast is not a recommendation to buy or sell any investment or financial products. Whether a particular investment or financial solution is right for you depends on the facts of your particular situation. Please consult your own professional advisors prior to taking any action based on the content of this podcast. Wealth management services are provided through Johnson Bank and Johnson Wealth Incorporated, Johnson Financial Group companies. Additional information about Johnson Wealth Incorporated, a registered investment advisor, and its investment advisor representatives is available at advisorinfo.sec.gov. Investment products are not insured by FDIC, are not deposits, and may lose value.